Hello, this is Danvi from danvi-charting.com. In this video, I wish to show you how options can be a powerful tool in helping you to grow a very modest trading account into something sizable over time. But the usual disclaimer first, and that is the content of the video should not be interpreted as advice or recommendation to do anything. You should seek your usual qualified advisors to use any things that have been suggested in this video. Trading financial instruments are risky, as all of us know, and options are at the very high end of the risk curve. Basically, options are a wasting asset, so in theory they can lose the entire amount that you invest, especially if it's not used in the correct way. However, I want to show you how you can actually use it correctly, and it would help you to reduce risk and increase your reward. And the manner of trading I am going to outline could be for everybody, but in particular for individuals who don't have time to necessarily monitor the market on an intraday basis or during the whole day. They have other commitments, so they cannot spend that amount of time in front of the PC during the trading hours. So let's begin. We know that in the last few months the market has been very volatile, and generally many of the stocks have taken a big tumble, and particularly many high profile stocks as well. So just to outline, we have, for example, during January in the US, stocks have earning seasons, and as a result of these earning seasons, whether the fundamentals were good or the earning data were good or not is not really a subject that I'm going to delve into. But just to outline, for example, when you look at a stock like Google, you will see that Google posted its earning announcement after the market closed last week, and what it tried to do is stock tried to make a new high and then basically sold off. So whatever it was, it didn't impress the market enough in order for the stock to continue climbing higher, which it has been doing for quite some time prior to this. But it's reached a stage where the earning announcement was, whatever it was, caused the stock to really drop. I mean, the highest price it achieved is about 810, and then last week it closed at around 700. If you look at Amazon, which is another high flying stock, same sort of thing happened with that one. That particular stock also had earnings announcement after the market close. Next day market open, it tried to make a new high and then basically sold off. I think actually the day when the announcement was made, a stock tried to make a new high, and then the following day market opened and it gapped down. So this tends to suggest that market is probably overpriced, and this is confirmed by the fact that it's been very volatile and most of the stocks are not making any further headways. Most of them have already topped long ago, sometime during 2015, and some of the strong ones are now making a high in December and January of this year, December of last year and January of this year. So it seems that even the strongest stocks are now struggling. So with this backdrop, the backdrop of weak market in general, I want to now show you how this could have been used along with the usual technical analysis that I employ, which do not really go into fundamental as much, but really only use technical analysis, and anything else that helps to confirm and to clarify. So the stock that we were looking for was LinkedIn. Okay, so this stock LinkedIn, which I'm sure you know what it is about, and regardless of its fundamental, I have a reason to believe that this particular stock has topped and is offering us a brilliant trading opportunity. In fact, the trade that I'm going to outline is going to show you how this would have been taken using the options. So we note, for example, that we made a significant low on this limited data we have here back in 2011. It had IPO in middle of 2011, May 2011, and you can see it made kind of a drop, a retracement, and then another drop. So in terms of Elliott wave, which is the primary technical analysis tool I use, based on Elliott wave, we made what is called a zigzag retracement. It's a retracement because we don't have a prior data, but we can assume that because a stock made a zigzag down, if the stock was not IPO'd in mid 2015, but in fact it was already trading long before that, then possibly we would have had data to show that we had a strong move up to this high, then an ABC or zigzag retracement to wave 2. So wave 1 would have been there, wave 2, and then we have moved up in a wave 1, wave 2, 3, 4, and 5 to make a larger cycle, wave 3. Then we retrace again in wave 4, and then we made 1, 2, 3, 4, and 5. So that seems to suggest that stock rose from this level at 57, and we probably completed a larger 5-wave cycle, establishing a top here. And then from that we have then dropped down in A, B, and C to give you a wave A. We've gone back up A, B, and C to produce a wave B. Wave A has 5 waves, 1, 2, 3, 4, and 5. So we've completed wave A, wave B. So the next thing is that we should be expecting a wave C. And the general guidelines for the Elliott wave, not the rule, but guidelines suggest that once the 5-wave cycle is over, then often the retracement comes back to a wave 4 of 1 cycle degree lower. So if the 5-wave completed a larger cycle, then wave 4 of a 1 degree lower would be this one here, which is around 130. So when we had a stock on last week around here, I concluded that the stock is heading toward that area, and it also had earnings out on a Thursday. I think the LinkedIn earnings on Thursday was after the market closed. So my question was, what was going to happen to LinkedIn? We've already seen Amazon and Google struggle after their announcements of the earnings results. So what was going to happen to this particular stock? Well, I had that chart. You see, it's exactly the same chart that I've gotten here, exactly the same chart. So I posted this chart in the stock on index chat room in the trading view, sharing my comments and asking question in general to say what is going to happen to LinkedIn once they release their earnings announcement. And one individual chimed in to say that fundamentally it's very strong stock, and I can understand his reason, because a lot of the stocks have risen very strongly over the last year or two, exhibiting potentially strong fundamental. But he also then qualified by saying he doesn't know how much of that strong fundamental is built up into the price. So really he indicated if this has already been built into the price, then stock might not do so well. So my comment was that we have a weakness in the general market, as I've just described. We have possibly 5-wave concluded cycle top. So my conclusion was that maybe on a earnings announcement, regardless of how good it is likely to disappoint the market, and the stock will probably gap. I didn't expect what happened, but I did anticipate that gap down on open last week. So that was, so I'm recording this one on a Sunday, which is 7th of February, and the earnings announcement was on Thursday after the market closed, and then on Friday when the market opened, stock gap down. So this is what happened. Okay, so this is a screenshot of a stock gapping down on a Friday. So on a Thursday it closed here around 190 mark, and then on a Friday when it opened, it simply gapped down, and I was expecting it to get to at least around about 130 or 140 level, but it actually went well beyond that. Now I didn't expect this kind of a gap. I expected a gap and probably, you know, somewhere trading around 160 or 150, but I didn't expect this. But anyway, this happened. So how could we have taken advantage of my analysis anticipating a strong drop in the market, because it's already now trending to the downside. It's made a first swing down for wave A, retracement wave B, and dropping down to complete wave C. So with that anticipation, we could have taken a short position, and to help you see what price we could have secured as short position, because we were expecting the stock to drop to 140, I considered this particular strike for the month of March 2016 option. So they would be expiring in March 2016, third week in March 2016, and the strike price I was looking for 140 when the stock was actually at 190. And the reason for that is because I wanted a couple of months time, and I was expecting the stock to drop and work its way towards that 140 level over the course of that period. And I didn't want to risk very much, because if I was wrong, I wouldn't want to lose a great deal. So this particular strike price is what I had in mind. And you can see that on a Friday when this market or this particular screenshot was taken, the difference market change is 26. So if you take 26 away from here, that means you could have secured this possibly for about $1.25 to maybe $1.50. And in fact, if you had followed this announcement, or rather the analysis, then we could have actually secured this when the stock was retracing to the upside. It was in congestion. It came down and it held, and you can see it's a zigzag retracement up. So if you had bought the option in that particular time period or earlier in the week, we could well have secured that for $1, because obviously on a Friday everybody knew that there's going to be earnings announcement, so generally the price of the options go up. So we could have secured this for $1. So assume that if you secured it for $1, then $1 would have resulted in a return of nearly $26–27 return. So that's like 27–28 times the value. If however you managed to buy it at $150, even then you would have had a return about 20 multiples. Now if you never traded options, a thing you need to remember is that you have to trade them in a size called contract, and each contract has 100 stocks in them. So when you buy one contract, and if you bought it at 150 each, that means you would be putting out $150 at risk. So if something went wrong and it never really went in your way at all, then between now and expiry in March 2016, out of $1.50 you could have come out and secured at least a part of that money by exiting the trade. But assuming that you couldn't reclaim anything, then you would have lost the entire $152 or $150 per each stock. So that would have been a complete 100% loss. However, assume that we didn't have this gap, and instead what we had is possibly we could have had a move that looks a bit more like this move here, right, where it's taken time, it's taken few months in order for that decline to play out. So we would have had 2 months or just over 2 months in order for our trade to work. So instead of gapping down, if it just simply, you know, continued in a good steady way, then we would have come up to 140 level anyway, close to. It doesn't have to come to 140. It could have even get up to 160. Our trade would have still made good money, but it wouldn't be as good as what we see on this particular screenshot. But maybe it would have come to something like you know, $7-8. You know, so $7-8 on initial investment of $1.50 would still be good return, I'm sure. So anything above 2 and 3 times the multiple, I think, is good return. But if you select a right kind of a stock at a position where it is going to continue in a particular direction very strongly, and then selecting the right stock and right option strike price and a time period, then it's possible to multiply the purchase price by sort of a minimum 2 or 3, but more likely to be 5 to 10 times, and in some exceptional cases like this one here, which doesn't happen every day, you know, 20 plus times, 30 times. Now, because it gapped so big, and you can see that LinkedIn lost nearly 43% of the value within a day, what I see next week now is it could continue lower, or it might stabilize and possibly retrace back and then, you know, make another steady decline before this particular cycle is over, and before we can expect any meaningful retracement to the upside. But anything it does here now will probably not be so profitable as much as what we had here. So I would have said on something like this, you could have exited if you only went in with one contract. If you went in with 2 contracts, so total outlay would have been something like $300, then you could have at least exited on one, and the other one you could have then see what the market does and exit based on price action, perhaps receiving even higher return. So this particular trade could have been very, very profitable, and these don't happen every day. But as I said, there are many opportunities where this kind of trades are now potentially available. If you look at, for example, just a quick scan of the sort of things I'm looking at is if you look at Facebook, which has been very, very strong, and it has now actually surpassed in capital value of the stock company many of the other larger companies that have been established for many years. So this particular stock, for example, you can see we have a IPO on this stock back in 2012, as you can see here, and in a similar manner, like we would have had a move up to 1 and 2, and then subsequently we have this narrowing, what we call rising wedge, and it's completed a 5 wave, and you can see it's now in a good strong decline to the downside. Now this downside will obviously have a staircasing down and retracements along the way, but you know, over a period this stock can come down quite a lot. So wave 4, 1 degree cycle degree lower, means that it's somewhere about 70, and it's currently around 100. So it could easily come to 70, or more likely it might actually retrace a lot more of this particular advance, and I would not be surprised for this stock to fall anywhere around 40 or 50 over the space of next 12 months. So you could go out and buy an option, you know, about $40-50 put option, but give yourself a time about 12 months, and it shouldn't cost you much more than about $1 or so, and over a course of next 12 months, if this stock does what we are expecting, it could multiply by several multiple of your initial capital. So I hope that this illustrates that whilst options are very risky because they're wasting asset, but if you use it correctly, it can actually help you to control risk, because you put down a very small part of your overall account size, and if everything goes wrong then you lose the 100%. But hopefully, because we have a time value in this, that if things didn't go in our favor and we feel that it's not going to mature or play out, then we could exit early and reclaim some of the initial investments, or we reduce the overall loss. But if it works in our favor, then anything more than double and triple I think would be welcome. And most professionals would say that if they take 1 unit of risk, they're looking for potential of 2 or 3 or more of reward, and this actually fits the bill. So whilst this is not a recommendation or advice, but I hope that the content that I've just laid out helps you to see how options can be a very powerful tool used correctly to grow a relatively modest account into something sizable over a period of time. And I hope that you enjoyed this and find that if this is of real interest to you, that you will take some time and look into this, do your research, learn some elementary things about trading options, and hopefully in days to come you might be able to employ this. And I will post out some further videos in due course showing you how certain trades have played out in reality. Okay, well, thank you for watching this. It's danv at danv-charting.com.